Hello, everybody. My name is Zeeshan Hasan, your tutor for ACCA Financial Reporting FR F7 tutor. And in this class, we'll be doing the questions from the recent past paper of March, June 2025 attempts. And here is our first question straight away. Let us first look at the requirements first, okay? And so here we go. So here we go. What are the requirements? Prepare, prepare the Stuipulotu group consolidated statement of profit or loss and other comprehensive income for the year ended 31st December 2018 X8, okay? And it's offering us 16 marks. And then we have the yeah. So Stupilotu company acquired 80% of the ordinary equity $1 share capital of similar company. Okay. On 1st April 2008. On 1st April 2008. Similar company is Stupilotu company only subsidiary. Okay. So they acquired it on 1st April. Draft financial statement is presented below. Now, first thing first, let us look at this is the first year of acquisition, and so we cannot uh, combine the results of revenue expenses for whole year. We acquired it in April. We acquired it in April 2008, X8, right? And what is the year end? What is the year end? The year end is 31st December 2000 X8. So that means we will consolidate. The year is starting from 1st January X8. Year is ending on 31st December X8. Okay, where we acquired it on 1st April. So the consolidation is for 9 months only. So far, so good. Now, so that means in this case, 225,000, we will take it full, plus 117,000. I'm taking millions into thousand. Okay. So into 9 divided by 12, cost of sales 141,000, 76,500 into 9 divided by 12. Same here. Same here. Investment income 1,000 only here. Okay. Finance costs plus into 9 divided by 12, and so far. Now look at the adjustments. So we have what they're saying, the fair value of the net assets of similar company at the date of acquisition was equal to their carrying amounts except for intangible assets. So the intangible assets had a carrying amount of 25 million and had a fair value had a carrying amount of 25 million and a fair value of 35 million. Okay. They were estimated to have a useful life of 20 years from 1st April 2008. Okay. Amortization charges are presented in administrative expenses. So, guys, what we have to do here, what we have to do here, the fair value of the net assets of similar company at the date of acquisition was equal to their carrying amounts except for intangible assets. Okay, and the intangible assets had a fair value of 25 million. Sorry, carrying amount of 25 million, as we can see here. Okay, whereas fair value of 35 million. They were estimated to have a useful life of 20 years from April 2006. Amortization charges are presented in admin expenses. So that means the value is increasing from 10 million. The fair value is increasing from 10 million. Okay. And it will have a useful life of 20 years from 1st April 2008. So far, so good. So what will be the amortization? We will take it as 10,000 divided by 20. Oh, sorry, 10,000 divided by 20. So amortization will be 500. 10,000 divided by 20. Amortization is, let us check once again, 10,000 divided by 20. So 500. 500 is our amortization per year, right? Which will be charged to the admin expenses. And so what will be the on the fair value of intangible assets? Intangible asset debit 10,000 and consolidated reserve, or you can consolidated reserve, or you can say, yeah, consolidated reserve is credited by 10,000, right? And for amortization, sorry, consolidated reserve, a consolidated statement of profit or loss, debit by 500, and intangible asset, credit 500 for amortization. So that's our first two entries. After 1st April 2008, similar company sold goods to Stipulator company. Okay. Yeah, just a second. Yeah, after 1st April 2008, similar company sold goods to Stuipulotu company for a total of 15 million. Similar company charges a markup on cost of 25%, and Stuipulotu company has sold 75% of these goods to third parties by the year end. Okay, so after 1st April 2000 exit, similar company sold, that is subsidiary company, sold goods to the parent company, parent company for 15 million. Similar company charges a markup on cost of 25%, and stipulated company has sold 75% of these goods to the third parties by the year end. That means um, 25% are unsold, and this is your unrealized profit. So how much is the unrealized profit in this case? Um, yeah, sorry, here 25% is the unsold goods, right? Multiply 20% into 15 million minus 25% markup. So 25% is still remaining. That is 3 million. So that's our unrealized profit, which is 750,000 is our unrealized profit, URP. Right? Next thing. Next thing. Similar company paid a dividend of 1 million on 30th November exit. Stipulated company presents dividends received in investment income. Okay, how much is that? 1 million. So that 1 million in consolidated statement of profit and loss has to be, see here. Yeah. Similar company paid a dividend of 1 million on 30th September exit 2000 exit. Stipulated company presents dividends received in investment income in consolidated, which have to be eliminated. Okay. And the intra-group dividend, intra-group dividend, as per the uh, stipulated paid 1 million. They acquired 80%, so 800,000 is the intra-group dividend. Okay. Next, also on 1st April 2008, Stipulated company acquired 30% of the ordinary equity shares of hardcore company. Stipulated company has significant influence over hard horse company, right? Hard horse company generated profit for the year ended 31st December 2000 exit of 20 million. Okay. And the investment in household company was found to be impaired by 1 million as the markets in which operates saw a significant decline following the acquisition. So, on 1st April 2000, stipulated company acquired 30% of the ordinary share capital of hardcore stipulated has significant influence. So that means it has a significant influence. That means they are the, associates. They are the associates, right? And hardcore company generated profit for the year ended 31st December exceed of 20 million. Okay, so on 20 million, what we will do, on 20 million, when we acquired first April, yeah, found to be impaired by 1 million as the markets in which it did operate saw a significant decline following the acquisition. So cost of investment 20 million less cost impairment, which is 1 million into 30%, 300. So you can say 3 will get almost 1.7, right? It's a rough. I exactly know to 10 million 5% loan notes on 1st April exit at nominal value with interest payable annually in areas the effective rate is 12%. The initial issue of the loan notes has been accounted for correctly, but no other accounting entries have been made. So for this, what we will do, 1.2 million into 9 months out of 12, we get 900,000, right? That's it. Now we did all the workings. Just we have to consolidate, right? Uh, I have some space here. So now what I will do here, I make the consolidated statement of profit or loss. So what I'll do, Stuipulotu, sorry, it's difficult to pronounce it, by the way. Stuipulotu statement of profit or loss for the year ended 31st December 2000 exit. So firstly, revenue 225 million plus 117 million into 9 divided by 12 that we have to, you know, uh, apportion it because of 9 months is valid for the consolidation only, right? Minus 15 million intra-group transfer of goods, cost of sales, right? So we will get how much? 297,700, 750. Okay. It's in millions. We're doing the working in thousands, as I told earlier. Now the next is cost of sales. Again, 141 million for the parent plus 76.5 million into 9 divided by 12 minus 15 million intra-group transfer of goods plus 25% into 25% minus 125% into 15 million. That is URP in inventories. So that was 184, 125. We got our gross profit, which is 113,625. Okay. Distribution cost 1.1 million for parent company plus 4.5 million. 4.5 million into 9 divided by 12 for the subsidiary. We get 25,875. Admin expenses now. It's 18.75 for the parent, remember? Plus 9 million into 9 divided by 12, the portion for subsidiary company. Plus now we have it's a 20 years life, right? Remember the amortization of the intangible asset. Remember it? Yeah, we have to do that. So let us take it. It is for 9 months. The total life is 20 years. So 9 months for 20, it's 240 months. So what's the fair value? We computed 35 minus 25. Remember that is 10 million. Either this way or that way. You can do both. Um, Sorry for that. Yeah, our distribution cost is 14,475. And next is here 25,875. Operating profit 73,275. Right? So far, so good. That's our operating profit. Now, after that, remember the associate. So, share of profit of associate. Share of profit of associate, 30% into 9 divided by 12 months into 20 million. That is a share of profit minus, remember the impairment loss 1 million? Yeah. Yeah. So it's 3,500. Then intra-group dividend. So for intra-group dividend, 1 million into 80%, right? Minus 1 million. That's 200. Then we have finance cost, if you remember. We did the working on it as well. And yeah. So 3 million. The parents, then 1.4 million into 9 divided by 12 of subsidiary. And then, the new loans which we took is 9 divided by 12 months for this, multiply by the cost of the interest rate of 12% into 10 million on loan notes, remember? Yeah. So total is 4,950. Finally, we get profit before tax, and which is 72,025. Income tax expense. Income tax expense 19,650. Profit for the year 52,375. So far, so good. And I hope it is clear till here. Now the next requirement. Now the next requirement. What was that? Explain the principles behind the accounting treatment of horse company and summarize what are hard horse companies specifically, how this would be recognized in the stipulated company group statement of financial position as at 31st December 2000 exit. We have 4 marks for it. So what we'll say, first thing first, according to IS 28, when company acquired between 20 to 50%, it's it is then known as associate of parent company, and parent company will account for associate company under equity accounting. In the equity accounting, they will they will only recognize the share of profit in the consolidated retained earning and deduct the impairment from the consolidated retained earning from H company. The Stuipulotu company will only have power to participate in the board only. That's it. So this is what is required for the second part. And I hope it is very much clear to you. If you guys have any questions, you can ask me anytime on my WhatsApp. Uh, we'll do another question very soon in our upcoming sessions. That's it for now. Take care. Bye bye.